As I started to really look at it without labels attached, in my view now, no financial vehicle works better for real estate than a supercharged, maximized, modernized, dividend-paying whole life policy.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 203. Today's guest is going to help us rethink debt, specifically the type of debt we might put on a real estate investment. Instead of going to a traditional bank or lender, did you know that there are tax-advantaged ways to loan that money to yourself? Mark Willis is here to explain how this makes sense and how it's possible. Mark is a certified financial planner, a two-time best-selling author, and owner of Lake Growth Financial Services out of Chicago. He also hosts the Not Your Average Financial podcast, and he helps his clients invest in real estate without going broke, and he helps them create retirement income that they won't outlive. Mark, pleasure to have you on the show.
Thanks, Brian. It's a pleasure to be here.
You are a certified financial planner, and you got into that field back during the Great Recession. Can you kind of just give us some background there as to what happened and what opened your eyes to this world?
Oh my goodness, it's quite a tale. My wife and I, we graduated from our private school degrees in the midst of the Great Recession with six figures in student loan debt and literally no plan and no jobs, because remember, we're talking Great Recession here. No jobs and no plan to pay off all that debt. It was like another mortgage payment hanging around our necks. And so, I got really interested, as you can imagine, Brian, in my own finances, figuring out how we were going to pay the bills. And, so of course, covering Sally Mae's nut to crack every month as well. And I started working for a CPA, and at the time, she was making phone calls to folks, unfortunately giving folks in their 60s, sometimes early 60s, late 50s, the news that she had just lost them half of that client's life savings. Can you imagine that?
Wow.
Being 61, 62, and all of a sudden you've just lost 25 years of savings?
She had lost them that, or the market had crashed and they had lost that amount?
Well, it's sort of out of everyone's control. She was a CPA and an investment advisor, and it was under her management, under her watch, that folks' 401ks were becoming 201ks almost overnight.
Oh,
and it was literally, hey, Mr. Client, I can't believe I'm saying this, but you can't retire like we thought you could. I mean, it was that clarifying and eye-opening a discussion that I was overhearing that made me sort of wonder if I'd gotten into the wrong industry, or at least if I had been dropped into the front lines of some sort of war. That's how it felt anyway, Brian. So, anyway, I found a particular drive and passion to either get out of the industry, because I just couldn't see myself recommending folks jump into real estate or mutual funds or things that were getting cut in half. If it was all just going to come tumbling down for my clients, when I was knee deep into the strategy later on. So my goal, my aim was to get out of financial services or find other strategies that would, with a high degree of confidence, guarantees, certainty, have an actual plan for my clients that wouldn't go belly up when the market did. So that was what sort of what caused me to stumble across strategies that were counterintuitive, not so average ways of growing and protecting wealth without taking unnecessary risk.
I've always been under the impression that certified financial planners, and investment advisors they're kind of corralled into only being able to put their clients into stocks and bonds and mutual funds. But it sounds like you've figured out a way to get outside of that world.
Absolutely. Yeah, a certified financial planner professional is really someone who has a comprehensive deep dive study into just about everything, Brian. I mean, the test itself is just a gargantuan mess of a test. I'm proud to hold the title, but boy, it took us several years. I say us, my wife and I, several years for me to get through all that study. And you can talk all day long about real estate, but the truth is most investment advisors have no interest in recommending real estate in your portfolio because well, wouldn't you know, they're not going to be compensated on it, and what's the old quote? If you try to convince someone of something when their salary is dependent on them not being convinced, you're going to have a hard time convincing them.
Yeah, well, I had talked to an investment advisor once, and he was telling me that, it's not only that they can't get their cut of real estate, but because of the oath that they take or some of the certification they have to go through, they can only advise on approved type investments, and that would only be like stocks, bonds, and mutual funds.
Sure. Yeah. It's a long list of reasons and a long sordid history as to why we as a country, when we hear the word retirement plan, we don't think real estate. We don't think contracts. We think 401k, IRA, mutual funds. Those are all things that didn't exist even 50 years ago. I mean, the first 401k, just for sake of example, started around 1981. A gentleman named Ted Benna was going through the tax code, stumbled across 401 subsection K, and figured out that he could offer this as an employee benefit. And well, wouldn't you know, now, not even 50 years later, all of us think that the 401k was created on the sixth day of creation. I mean, it just is not the case, The 401k, Brian, is not even old enough to retire yet. And yet we all think it's supposedly the only way and the best way to get to retirement. It's simply not true. And I was classically trained as a CFP, but let's be honest, real estate goes clear back to the pyramids, whereas the 401k is a relative newbie on the scene.
So you are a CFP who will advise on real estate and other types of alternative investments then, huh?
Absolutely. Our job as a financial planner is to give the best advice to put our clients in the best position possible where they can reach their goals. And that's the bar none. I don't care if it's raw land. I don't care if it's a mutual fund. I don't care if it's an insurance contract. If it's in the best interest of the client, we should be talking about it with folks, no matter where the idea came from, right? Or if you're going to be paid for it.
Yeah, absolutely. So going back to the Great Recession, and you saw people's 401ks being cut in half, and I mean, just people having to work a lot longer than they anticipated when they started these retirement funds. What were some of the alternatives that you gravitated toward as you left that kind of the traditional stocks and bonds and moved into the alternative assets?
Yeah, the biggest, I guess I'll start with the problem, because mostly, we can't solve the problem with the same tools that created it in the first place. And I would say the biggest problems that I saw going into 2008 and wading through that Great Recession was threefold. It was sort of a tornado of three different elements all combined together to create the Great Recession. That was living beyond our means, or our lifestyle was getting bigger and bigger. Our McMansions were getting too big for our incomes. Debt was the second element here, where we were, spending, and this is according to the U.S. Commerce Bureau, 35.9% of our total income was going to service debt. And that's still true, by the way, even today. In fact, we have more debt now than we had in the last recession.
Would that be basically credit card, auto, and home debt?
Everything, yes, correct. Everything, student loans, big time, of course, car loans, yes, mortgage debts, of course. Yeah, if you can imagine, that's the volume of your interest. So if you made $1 today, 35 cents of that dollar would go to just service the interest on the debts, even if you had low interest debts. It's not so much about rates on your debt, and this is a big deal for a lot of real estate investors that all have very low interest mortgages right now. But we're spending, in terms of volume, on the average, 35%. If time is money, Brian, that's a third of our day just slaves to a bank.
Yeah, that is right? Very high number, that percentage.
Yeah, there. And that's gone up tremendously. In 1940, we only had about 11 cents on the dollar servicing debt. Now it's more like 35. And by the way, back in 1940, we were saving about a third of our income. So we really went from a savers nation to a debtor nation over these last few generations. Now, the third element that I kind of saw was the coup d'etat for our country was speculation. So most of us couldn't save, and the average savings in this country is about 5% of our income. So we're spending 35% on debt, and we're only saving about 5 cents on the dollar. in any sort of savings or investment vehicles. So here's what I hear a lot of our clients say when they first walk in the door of our office, Brian. It's something like this. Hey, Mark, this lifestyle thing is out of control, and I really can't save much more than 5% of my money. So I'm going to have to put that 5% into riskier and riskier assets to try to hope and pray that my rate of return will be higher and make up for my lack of saving. So I can't save, so I need to invest or risk more and hope that my rate of return will be higher. Those three elements, lifestyle, debt, and speculation, I believe, not only caused the Great Recession, but continues to plague our culture in this country.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. So those are the problems. What are the solutions when your clients come in the door and say those things to you? What do you counsel?
Sure. Well, for many people listening to this podcast, myself included, the answer is keep calm, invest in real estate, of course, right? So, real estate provides a ton of awesome benefits to solve some of those issues. We're talking about security of the asset. There's going to be less volatility on our real estate portfolio than, say, a mutual fund. There's cash flows, oftentimes, especially with rental properties, as you know. You can do things like occupy the property. If you had to move in, you certainly could. And then, of course, there's plenty of tax advantages in the tax code, like capital gains rates and losses being carried forward and so forth, cost segregation. All those things are powerful reasons to look at real estate, compelling reasons to add real estate to your portfolio. Now, there's some hurdles. Honestly, let's be honest. According to Case-Shiller, real estate's only grown about 1% a year above inflation. And it can be really costly to buy, sell, or maintain those properties. And rental properties are great when they're rented, right? But can anybody here, listening to this episode, imagine a world where we're not in 100% occupancy with our rental properties? I'm guessing, the average is closer to maybe 80%, 75%. Yeah. Does that sound about right?
I guess it depends on the area and how quickly you turn over your units. But you're talking the single family world. We also have a lot of multifamily investors too, where that's you're going to see much higher occupancy rates.
Good. Well, that's key. And the key is who's in control of those numbers. Who's in control of our appreciation? Well, we have a little bit of control with forced appreciation strategies. But what is really guaranteed with our equity and our real estate? What's guaranteed about that tenant if they're going to pay rent every month or not? At the end of the day, the real estate portfolio, from a CFP's perspective, doesn't completely, at least not 100%, insulate us from the financial crises that we'll probably go through. We've had two major ones since the year 2000. Brian, kind of think of it this way. When are you most likely going to need cash? Well, probably during a crisis, right?
Yeah, that's you need the cash to take advantage of all the great deals you find during the crisis.
Mm-hmm. Yeah, when are banks least likely to give us cash?
Well, exactly, right during the crisis. It was really hard to get lenders to lend money in 2008.
And then what's the hardest time to sell our properties at fair prices?
Yeah, same period.
Right, you bet. So one of my favorite quotes, I believe Mark Twain said it, a banker is a fellow who will lend you his umbrella when the sun is shining, but wants it back as soon as it starts to rain.
Yeah, that works.
Yeah, so to answer your question about strategies and solutions, I do think real estate has to be a core part of any long-term successful investor. And the key question I guess I always start with as a financial planner is, what do I want my money to do for me? Or in this case, for our clients, what do you want your money to do for you? And it's a really fun thought exercise, but you could ask yourself the question, what do I want my money to do for me? If you could design the perfect financial vehicle, for real estate investing to complement your real estate deals, what would that look like? What sort of characteristics would you want it to have? That's really, I think, an important thought exercise, Brian, just to help folks sort of move away from the labels of, savings account, mutual fund, brokerage account. So just taking labels off and saying, well, what sort of characteristics or attributes would I want my money to have? That can be a helpful thought exercise. So
help me understand that question. So give me an example of what you mean.
Sure. Yeah. Good question. So, I did this myself. I sat down and said, well, what do I want my money to do for me in my own family's life? Remember, I was coming out of the Great Recession. I was trying to get, my feet under me, paying off some debts and build a financial future where I could, escape the rat race and become financially independent. So what I wanted out of my cash was liquidity. I needed access to the money for emergencies, opportunities, financing purchases, that sort of thing for real estate deals. Some sort of predictable guarantees on the cash. I needed to make sure it was going to be there when I went to go get it to buy some real estate, for example. I wanted significant tax advantages, some sort of accumulation without taxes every year. If you think about it, our savings and money market accounts are getting a 1099 every year on that little bit of interest they pay us. So I wanted I want some sort of shield against yearly taxes, and I wanted to be able to access the money totally tax-free. I wanted protection from creditors. I didn't want to get sued if someone slipped on a banana peel outside one of my rental properties. I didn't want someone stealing all my other cash in a lawsuit. And I wanted it to be private. I wanted it to be off the radar of the IRS and off the radar of Congress and other predators that might try to steal my identity and that sort of thing. So these were sort of my little list. Does that spark any ideas for you, Brian? Anything else you'd want your cash to do for you or you could think would be helpful for real estate deals?
Well, I think just ease of access.
Yeah.
Not having to wait a long period of time to actually get the funds.
You bet. Help make you a cash buyer, make you more competitive in buying a deal, because we all know the money is made when you buy the property as much as when you sell it, right?
Mm-hmm. Yeah.
So getting liquid access to the cash, that was sort of my little laundry list. And we could keep going. I mean, we could talk more about that. But, for me, I that's partly what got me so interested in becoming a certified financial planner. And so I started studying, a little north of 400 different financial products and several thousand different strategies for, everything from dynastic trusts to, ETFs to gold and commodities to futures trading to real estate deals of all sorts. And, what came across my desk along the way was a strange, very old-fashioned financial vehicle that's been around about 160 years. And that's a modernized form of dividend-paying whole life insurance. Now, for me, that was it almost was the end of the conversation, because I had been really, brainwashed by a lot of radio personalities who had said, never, ever touch life insurance except term insurance, buy term and invest the rest.
Yeah, that's sort of the conventional wisdom.
Oh, big time. And I was steeped in it. I mean, I was like brewed tea in the buy term and invest the rest. I was fully steeped. But, as I started to really look at it without labels attached and look at it from a fresh perspective, in my view now, no financial vehicle works better for real estate than a supercharged, maximized, modernized, dividend-paying whole life policy. And here's a few reasons why.
Tell us what that is, first of all.
Okay.
Because
sure.
it sounds like life insurance.
And that's what it is, for sure, yeah. So in general, most of us might at least know that there's this thing out there called life insurance. And there's essentially two forms of life insurance. There's the kind you rent and the kind you own. So renting insurance is term insurance. So I'm renting that term insurance policy for 10 years or 30 years, and I'm essentially renting the death benefit. If in case I happen to get my wings in that 10-year period, my family would get a lump sum. It's sort of gambling, so to speak, on when I might pass away, or at least protecting my family if I should pass away too soon. So renting a life insurance policy is sort of like renting an apartment. There's no equity in term insurance. The death benefit is level, which means it does not increase with inflation, okay? But my premiums are going up. The landlord is raising the rent on me. I'm getting older, so my term insurance over time starts to really increase dramatically. And so those are some elements to term insurance that sort of feel like renting an apartment. In contrast to that, Brian, whole life insurance, cash value life insurance, is more like owning a home. You have a level set contribution, meaning your premiums are not getting higher and higher. They're staying level, sort of like paying a mortgage is level. And your death benefit and your cash value are growing, keeping up with inflation, much like equity in a home. And again, much like equity in a home, you have this equity in the policy called the cash value. So while I might pass away and leave my family with the whole life policy, Brian, a big death benefit, the cash value is what I can use and spend and enjoy on this side of heaven, before I get my wings while I'm alive. Which is, it's way more fun to spend money while I'm alive. Let me just say that.
Yeah. So yeah, definitely. Well, then you were about to explain how it all works. Please go ahead and do that.
Okay, and then I'll connect it directly to real estate. I believe there's some real significant connections. I do believe that when you combine two things together, two financial vehicles together, they sometimes can do some pretty great things. Like nitro and glycerin, they can be more powerful together than they might be apart. So whole life insurance, if it's properly structured, and I can't overemphasize that enough, whole life insurance can be really powerful. So what is whole life? Whole life insurance is a 160-year-old financial vehicle. So way older than our great-grandparents. Whole life insurance even predates the IRS. Okay, and it has been growing and increasing in value guaranteed over the last 160 years, not missing a single year. Returns are pretty nominal. They're going to be better than other cash equivalents in your portfolio. Brian, to your point, you can get access to the cash in the policy for any reason very quickly. We're talking within a few business days for your real estate deals.
Go back to the returns are nominal. What does that mean?
Mm-hmm. Yeah, it's going to be better than a money market account or a CD. Low to middle single digits is what you might find. You might find 1 or 2% on on money market accounts or CDs. These policies are going to be doing better than that, but they're never going to be doing, as good a year as the best years in the stock market for sure.
Right.
It's a cash alternative is what you should really see this policy as.
So, because we're moving into an era now where, as we record this, the Fed just dropped the interest rate again another quarter point. And people are talking about negative rates, in the future. Mm-hmm. Does the interest rate have anything to do with the returns on whole life?
It's not exposed directly to, like, I won't see my whole life policies suffer by this recent quarter point drop. Not this year, not next year. Now, if they go tremendously lower, we might see the dividends, and this is a dividend paying whole life policy, might someday suffer, but it typically lags the prevailing interest rate environment by a few years. And so, right now, dividend paying whole life is experiencing the same environment that the rest of the interest rate world is experiencing. But what's really interesting about this is it's beating what other bond funds might experience, just because whole life insurance is issued by insurance companies, Brian, that is, they're able to hold those bonds all the way to maturity. And because of that, the interest returns in the general fund of the life insurance company is going to be higher than you and me, mere mortals, investing in retail bonds. So that's a little deeper than maybe you wanted to go, but in principle, you can expect these policies to do a nice, decent, middle single-digit rate of return over the course of the policy's lifetime.
So middle single digits. I'm trying to figure out if that's like over 2% and under 5%. Is that kind of the range you're talking?
Somewhere in there. I've seen over the last 60 years, I've seen policies as low as 3%. I've seen them as high as 7%. And these are after-tax returns. But I never really focus on the rate of return of the policy. It's not the key that I want to see unlock the door. The key is it liquid? Is it accessible? And is it guaranteed? So, I have seen the policies do pretty nicely over a long period of time, but I'm never going to be wowed by double-digit returns in the policy itself. The key is using the cash value for all my other investments. And that's where the magic really begins to come through. Does that make sense?
Yeah. I want to hear how that magic comes through.
Okay. Well, with this cash value that's doing, nominal, conservative, boring even rates of return, The key is every single year, those returns are yours for the rest of your life. The gains are locked in. So every time you get a return in a mutual fund, you don't know if it's really yours until you sell that mutual fund, right? With the policy, every time you get cash gained in the policy or the dividends are applied to the policy, it's locked in. It's your cash for the rest of your life. So that's a key piece to it. And then maybe most importantly for real estate purchases, when you access the money, you know how on a piece of real estate you can get a HELOC or line of credit?
Yeah. Mm-hmm.
Let's talk about this for a minute. So let me pull over. Let's talk about this metaphor of the HELOC. So the house, let's say the house is $300,000 in value. And let's say you get a HELOC for $100,000. How much is the house worth on Zillow? Let's say it's still worth the same price, right? $300,000.
All right. Yeah. The value
even though we have the HELOC.
Up.
There you go. Okay. What if you took the HELOC and you invested it, or spent it and bought a car or whatever? The house is growing, and you use that cash at the same time, right?
Mm-hmm. Yeah.
Now, with a HELOC, there's some downsides to using a HELOC. What are the downsides? The bank is going to take our interest.
Mm-hmm.
They could possibly call our HELOC, and now we're in big trouble. And there's no guarantee. Yes, sir?
It also shows up as an amount you owe on your credit report.
Oh, good point. Yep, that'll ding your credit report, giving you maybe less access to future debt. And then there's no guarantee the house is always going to be worth $300,000, so we could possibly go upside down, right?
Right.
With the policy, there's some similarities and some key differences. So I'll just say it. When you borrow from a policy that's properly structured, it'll continue to grow. The cash in the policy will continue to grow as if you never touched a dime of the money. Okay. Now, that sounds crazy, but I just explained an example of the HELOC that works the exact same way with some key differences. With the policy, it is guaranteed to grow. The cash will grow every single year without market risk or any other risk. It's in the contract. So unlike a house that might go up, upside down, you'll never be upside down in the policy. It's a guaranteed cash accumulating machine.
So, all right, I think it would help to have an example of a real life example, hopefully revolving around a real estate investor who might have used this concept to invest in real estate. You have something you can share with us?
Sure. Let's talk about a very simple strategy on how this might fit into your real estate portfolio. Again, I see these two strategies really complementing each other. So the first thing you could do in very simple steps is pour money into a policy that you comfortably feel like you could set aside. That's very simple, just opening up a policy and structuring it correctly. So repositioning your current savings or whatnot to put it into a policy. And when you're ready and able and find the right deal, simply borrow from the policy and make a purchase, a cash purchase. You'd be a cash buyer in the eyes of, the transaction, the real estate transaction. And now the policy is growing and you have the real estate deal at the same time. So here's an example of how that might work. Let's say that you had, and in fact, this is an example of a real life example of a gentleman. About 10 years ago, he set up a policy with us and put in about $32,000 every year into his whole life policy. Now, right there, that should surprise a lot of folks. At least it did me when I was first thinking about this. Like, why in the world would you throw $32,000 perfectly good dollars into something like whole life insurance? And again, it's all about how the policy is properly structured. By the time the 10th year rolls around, he's got $400,000 in liquid available cash. And in the 11th year, he actually has planned to take out the money. $350,000 comes out as a loan. So he takes out most of the cash out of the policy. And by the time he pays that back over the 15-year, by year 15, all of the money will be back in the policy. His policy will have $515,000 in cash. He'll have the real estate property growing and appreciating in the neighborhood. And his overall rate of return will be in the double digits between the policy and the real estate deal. And I can get into more detail if you'd like, Brian, but that's how it works in a nutshell.
Okay, so then the first two questions I would have is, let's say someone just puts $100,000. They open one of these policies, put $100,000 in. Is that $100,000 that they can then borrow from that policy?
Good question. Yeah. So, is this something that's a surefire way to, is this a magic pill that everyone should just do? Obviously not. There's a few things that you have to consider before you do this strategy. First, there's a death benefit attached to the policy. There's another quick example here. You mentioned $100,000 going in. There'd be a cost of the insurance in the first few years to make up for the liability to the insurance company of that death benefit. If I should pass away the next day after starting the policy, that would be an expense to the life insurance company. So what they do is they hold back some of that cash value in the first few years to cover that liability. Does that make sense? Does anything there not make sense?
Well, you say they hold some back. So I guess the real question is, how quickly could someone open up one of these policies and then start taking advantage of this strategy that you're talking about?
Yeah, you could, I have a story of someone who sold a condo here in Chicago, one of the downtown Chicago condos, and then put the money into a policy. It was about $150,000 went into the policy. And within 30 days, she borrowed out about $120,000 to go and invest in a new real estate deal. Okay. Now, there's a loan against that policy, but it was within 30 days of starting the policy that she was able to borrow out almost all of the cash in the policy. $120,000 came back to her.
So I'm a little confused because you just said that the insurance company likes to wait for a period of time before they start loaning that money back to you to make sure that you don't die and they lose money. But then the example you just gave, she was able to take out a good chunk of that within the first 30 days. So what am I missing there?
Yeah, a good chunk is the key phrase there. She put in $150,000. Well, she borrowed out $120,000. First of all, so that's a $30,000 delta right there. But the expense on the policy was much less than that. She's usually able to borrow out about 90% of her cash value within 30 days of starting the policy. And so it's pretty common. And again, that story was a lady who had sold a condo, taken the equity of the condo, $150,000, dumped it into a policy, and within about 30 days, the policy had available to borrow out $120,000. And that's what she did. She took that $120,000 and went to go buy a piece of real estate, a rental property actually. So there's a loan against the policy, but the policy continues to grow on the entire cash value, even the amount she borrowed out.
Okay, and she's taking out a loan against this policy. Is she paying interest on it, and what happens to that interest?
Good question. And then I'll even talk through how the renter repaid this loan for her. So I'll kind of give you a sneak peek on that too. But yeah, there is loan interest on policy loans. I always tell folks, this is not the insurance company is not a charity. They're still going to charge interest on policy loans. However, if this policy is designed correctly, and that's going to be a common theme for our episode, I think, but if the policy is designed correctly, it'll be issued by a mutual life insurance company, not a publicly traded life insurance company. So there are two kinds of companies, obviously. There's the publicly traded life insurance companies, which are owned by shareholders on Wall Street. And of course, the profits of that insurance company would go to the shareholders. Whereas the kind I would typically recommend for clients if they're wanting to do this concept would be to use and to issue a policy from a mutually owned life insurance company where the policy holder is in essence the owner of that life insurance company. Does that make sense so far?
Sorta. I'm still not clear on who gets to keep that interest.
Yeah, well, think of it like a co-op. If you and I, let's say, went in together and started a mortgage company, and you and I were owners of this mortgage company, okay? And let's say that we were, issuing mortgages and so forth for customers, but then, maybe I needed a mortgage for my personal home. What do you think? Would I go to our mortgage company that we co-own, or would I go to some other bank down the street?
Well, I think it would depend on the interest rate and the terms.
There you go. All right. Good. I'm happy to hear you say that.
Okay.
Is there any reason why, even if I charge myself extra interest, is there any reason why I'd go to the bank down the street?
Well, I guess you got to look at the overall picture. What kind of interest am I charging myself? And am I sharing that with everyone else who's got an insurance policy through the same mutual company? Mm-hmm. Or is it going directly into my pocket?
There you go. Where does the interest I'm charged ultimately end up if I'm the owner of that company? Well, back to me and you and everybody, right? Mm-hmm. So yes, there is an interest rate. Usually it's below market rates. Like, for example, Brian, if the loan took you 4 years to pay off, the APR on the policy loan would be about 1.9, 2.1%, somewhere in that ballpark. So that's pretty low. That's below most mortgages that are available out there that I'm aware of. And it's charged on a simple interest schedule. But the key thing to remember is my policy is continuing to grow and compound even on the capital I borrowed. And that's what we call arbitrage. Okay.
You brought up a word that I want to follow up on, arbitrage, but I'm still hazy on this concept. So if I take out a loan, or in the example of the woman who took out a $120,000 loan on the $150,000 whole life insurance policy that she got, mm-hmm. She was paying a lower than typical interest rate. Mm-hmm. That interest rate payment was going to the mutual company, but then it was being reflected in the distributions that she's receiving each.
Correct.
Is it each month, each quarter, each year?
Yeah, correct. Dividends are paid to her policy on a yearly basis, and would be the case for all policy holders. And that interest is pooled with the bond portfolio and everything else the insurance company owns, and then is shared with the owners of the company. That's right. You and me and the lady who had the policy. Yeah.
Okay, good. Yeah, that's the distinction I was trying to make. She's not paying herself interest, but she's paying the mutual company interest, which is then being shared by all the other owners like
Correct.
Yourself of this type of policy. But you mentioned a 4-year payback. Was she able to get like a 30-year fixed like you would at a traditional bank, or did she have to? Was there an accelerated balloon payment that she had?
Good question. So another key benefit, I suppose, is that we are the banker here, so we get to decide what our own repayment schedule will be. So for her, she wanted to pay it back over 10 years. That was her choice. The renter, the tenant in the property, was paying her, a little north, about $1,100 a month. So it was paying her $13,200 a year, and that allowed her to repay that policy loan over a 10-year period. But for her, if the renter moved out, if it was a normal mortgage, boy, she'd be up a creek, right? The mortgage would still be due, whether there was a renter in there or not. But with the life insurance policy, Brian, you're able to start and stop or change your repayment plan at any point for any reason. The life insurance company doesn't care if you pay back the loan at all in your lifetime. If you pass away with a loan outstanding, the loan is just deducted from your death benefit when you pass away.
She could have said, all right, I want a 30-year fixed loan on this. You're saying that she has that flexibility to decide that.
Here's how it goes. As she's taking the loan, one of my staff members, for example, will just ask, hey, do you want to repay this loan on a monthly basis? Do you want to wait until you get a renter in there? Do you want to pay $25 a month, $0 a month, $2,000 a month? Or just let us know when you want to repay it off. Literally, the flexibility is completely in her camp. There is no 30-year fixed schedule. The life insurance company won't demand or require her pay it off. Now, there are a couple of gotchas here. You can have a full lifetime to pay this loan off, but if the policy lapses, you could lose the life insurance, and the loan would be essentially netted out by the cash value. And you could have a taxable event if there are gains in the policy. So I always tell folks, we want to watch the loans and make sure we're repaying them and not stealing from our own bank, so to speak. But I've never, in the history of our practice here, I've never seen that happen to anybody, but it's technically possible.
And what are the costs and requirements of servicing this loan?
There is no loan origination fee. There's no, you don't have to employ anybody to report to the life insurance company what your P&L or balance sheet is. I don't think there are any other costs that I'm aware of. In fact, I'm certain that unlike a regular bank loan, there are no additional costs.
Yeah, well, with a bank loan, just getting a simple residential mortgage, there's so many hoops you have to jump through, and financials and disclosures and bank statements, that it becomes very it can be very uncomfortable procedure. So, are you saying that doesn't exist with this type of loan?
It takes about 2 sheets of paper and about 5 business days, and the money is directly deposited in your bank account. No questions asked.
Okay, and you mentioned the word arbitrage. Explain what you mean by that.
Well, it's the spread between the cost of the financing. Maybe that was, let's just pick a number. Let's say that was $7,000 over 10 years if you totaled it all up. Maybe it's more or less than that. And then the growth of the cash over the same period of time inside the policy. So, maybe for sake of conversation, let's say that was $30,000 over the same period of time. So that spread between the cost of the money, which was $7,000, and the growth of the policy, in our case, that was $30,000, the difference there is $23,000. That's arbitrage. Okay. In other words, that's additional yield you had in your pocket that you would not have had if you had only paid cash for that real estate property.
All right. And what kind of financial strength do you have to get into this type of policy? I mean, can you start it with $5,000, or is there a minimum amount that you need to invest in it and then put into it each year?
Yeah, great question. I'd say if you're not sure if you can do this, you don't have to be 22 years old to start. The lady I was just talking about, she's in her early 70s when she started her policy. So literally, birthday candles are less important now on these more modernized forms of whole life insurance. You can start with a couple $100 a month or a couple $1,000 a year, something like that, or as much as a couple $1 million a year. In fact, if folks are really wanting to dive deeper into this, look into bank-owned life insurance. Google that term, bank-owned life insurance. You'll see how prevalent this asset class is in the tier 1 capital of most banks. Hundreds of billions of dollars a year going into these policies. With that in mind, you could use the policy. If you can't pay for a real estate deal in cash out of this life insurance strategy, maybe you start small with things like, your property tax or your homeowner's insurance, or covering the washing machine that the renter just destroyed, or whatever else you could think of that you might need to make big purchases for your rental properties. It really is literally a line of credit to yourself in a lot of ways that you can use for any purpose, keeping in mind that we still are living in the real world. You want to watch and grow and manage this policy, and you don't want to necessarily neglect it or steal from your own bank, so to speak. But other than that, it's really just a pool of cash that you can use for emergencies or opportunities.
Yeah, can it really be used as a line of credit where you can wire money in and out on a regular basis?
Yeah, I'll be clear on that. It is a very liquid account. I mean, like I said, about 5 business days is what you could expect to wait between asking for the money and it being deposited. It's not a debit card or a credit card or a true line of credit in the sense that you wouldn't be able to wire money in and out. It does take a few days, but it's essentially your backup plan or your big purchase account. Think of it that way.
I know you have to get going, otherwise I'd have a lot more questions for you. Why don't we kind of wrap up, though, with any advice you might have for our real estate investors out there who you've captured their interest and you want them to take it to the next level?
Well, I'll certainly be happy to come back for a part 2. In fact, we could talk about literally becoming the mortgage company for all the other investors, because there's tons of strategies around that as well. You can literally become the mortgage company, or the banker, you might say, for all your competitor investors out there. But for sake of our time today, really, it's all about how you think, and it's all about what do you want your money to do for you. This is a neat strategy. I do think it fits great with the real estate space, but don't do it just because I said it or you heard it on this awesome podcast, on Brian's awesome podcast. Do your own due diligence, research this. I'd be very happy to connect and talk with anyone who'd like to learn more. And we have a number of associates and colleagues that work with me who are probably smarter in this realm than even I am. So do your research and then talk to a competent bank on yourself professional. I'd say the best way to look into this is to Google the phrase bank on yourself. Bank on yourself. Bankonyourself.com is a great space to go. And Brian, if it's okay, would it be all right if I shared a link for folks if they want to reach out to me and learn more?
Yeah, that was going to be my last question. Just how would people get a hold of you, and where would you send them?
Okay, yeah. If you like podcasts and want to learn more and sort of date us first, go to Not Your Average Financial Podcast. That's where we've got over 100 episodes on this content. And if you'd like to reach out and have a consultation with one of my colleagues or myself, go to growmorewealth.com. That's growmorewealth.com. You can just request a 15-minute strategy session, no cost, and see if this strategy might fit your real estate deal and real estate portfolio. All
right. Well, Mark, thanks for bringing this to our attention. I mean, this is an interesting concept that I've kind of heard about, but never really understood. You've definitely made it a lot more accessible, this idea of taking out a whole term life insurance policy and borrowing money from it. And I assume that the returns you're getting on this life insurance policy, are those tax-free?
Yeah, the policy grows tax-deferred inside the cash value. And then if you ever access the money, you can do it without any taxes due, a lot like a Roth IRA.
So it's tax-deferred until you start taking it out after retirement age?
What I mean is, it isn't taxing you every year like your money market account is. And then it's tax-free anytime you need the money. If you take a combination of withdrawals and loans, you will take both the principal and the gains can be accessed completely tax-free, much like a Roth IRA.
Thanks so much for being on the show. This has been really interesting.
You got a great podcast. It's been an honor and a privilege, Brian. Keep up the great work.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.